If you're over 55 years old, under age 80, and especially if you have kids, you should listen to this video. So let's talk about the biggest backdoor Roth conversion. If you're an older investor, that is somebody north of 50 years old, you have probably been following all of the asset allocation advice that you will get from the traditional investment houses, whether it's Fidelity or Vanguard or any other place. The older you get, you should probably reduce your equity portion, increase your fixed income portion, primarily to reduce risk. The second thing about that is as you move through these different years and you increase your fixed income portion, if you're 50% equities and 50% fixed income, you have a lot of choices in both the equity box and in the fixed income box. If you're a DIY person, you're probably buying low-cost ETFs, and you might even be looking right now in 2026 at the 10-year bond. And again, the 10-year bond is running around 4.3%. And so here's an idea for you. When we talk about lifestyle products, it's going from an era when you're young, you need a certain kind of products, then middle-aged, different products, and as you're aging, you need specific products for aging. Let's talk about what you might be considering doing with a Roth conversion. Very rarely do Roth conversion discussions bring in the tax hit to your children. The last thing your kids want from you is your tax bill. If you leave them a $1 million IRA pre-tax or a $1 million 401k pre-tax, since the passage of the Secure Act 1 and 2, there is no way out. They're going to pay your income tax. That's it. Whether they pay it once, they pay it in 5 years if it's in trust, or 10 years if they get it directly, you're going to be adding $1 million to their income. If in fact they took out all the $1 million in 5 years, most certainly they'd be in a top tax bracket. And if they took it out all at once, of course they're going to pay max taxes. If you're an asset allocator, if you're paying attention to reducing your equity portion of your portfolio and increasing your fixed income part, let me just say, unequivocally, the number one asset you should use in your fixed income portfolio is the fixed and guaranteed assets. I will tell you the definition of a disaster. A disaster would be, just use an example of a $1 million IRA. You converted $500,000, you left it in the market, you lost 30% on money you just paid taxes on. Imagine having just paid all that money for taxes and then losing not only your investment, but your tax money in the markets. If you're going to do a conversion, let's be safe with the conversion money. The average retirement fund in America now is $1 million. That retirement fund should be 50% in equities and 50% in fixed income. If you're a person who hires a money manager to help you. And at $1 million, there are many, many people in America that hire an investment manager. And a classic investment manager charges 1%. 1% of $1 million is $10,000. The $10,000 that you would normally pay over your 30 years of retirement, like say 55 to 85 or whatever, that's like $300,000. But let's just say you kept your great equity manager and you paid half the fees, just $5,000 a year, because you put your fixed income into a no fee bucket. And you say $5,000 a year for the next 30 years, that's $150,000. The number one thing I want you to mark down is by allocating 50% of your portfolio when you convert your Roth to a non-fee fixed income box. If you cut your fees in half, you're going to save a lot of money. That's number one. Okay. Stay tuned for part 2